You hear the phrase 200-year-old bank, and you probably picture a slow, boring bureaucracy totally bogged down in red tape, right? We'll scratch that. We are diving into this explainer today to look at how Citigroup, one of the biggest financial institutions on the planet, is fundamentally transforming itself for the modern era. On the ground right now, they're executing an incredibly dynamic, high-speed pivot. We're going to break down exactly how this transformation is happening by looking at three major, totally interconnected strategic moves.
Here is our roadmap for today's explainer. We'll start with a bank in transformation, then explore revolutionizing credit card rewards, powering the AI era, and rewarding the shareholders before wrapping up with the future of banking.
All right, part one, a bank in transformation. Let's look at Citi's evolution in August 2026.
Moving right into it, part two, revolutionizing credit card rewards, specifically looking at the card acquisition.
To really grasp this strategy, we have to look at what Card actually does. They're a New York-based commerce media platform. Think of it as a brilliantly smart matchmaking engine. It uses machine learning and verified transaction data to connect banks, merchants, and you. So instead of getting generic points that you might never use, Card delivers highly personalized offers directly to the consumer.
And this is a literal game changer for Citi's 70 million U.S. card members. For decades, the old way meant banks burning through cash, heavily subsidizing expensive points-based reward systems just to keep you swiping their cards. It's a massive expense. The new way, the card way, flips the script entirely. It brings merchants directly into the fold, letting them fund the benefits to attract your business. This shifts the heavy cost of rewards away from the bank, gives merchants a powerful new way to engage, and gives consumers way more relevant deals.
Ben McKinnon, the founder and CEO of Card, really hit the nail on the head here. He noted that joining forces with Citi and applying their platform to a user base of 70 million card members fundamentally accelerates their vision for building the future of commerce. It is the perfect marriage of innovative, fast-paced FinTech agility and massive institutional scale.
So why does this matter? Well, the crucial takeaway here is that this isn't just some flashy app update. It's a fundamental shift in how credit card loyalty is going to be funded going forward. By bringing Card's tech and their merchant relationships in-house, Citi is actively building a self-sustaining commerce ecosystem. It creates real value for the card member who gets better offers, the merchant who gets targeted sales, and the bank, which slashes its dependency on costly points. Win, win, win.
Okay, let's zoom out to the macro level. Part 3, powering the AI era by financing the infrastructure. We hear about the AI boom constantly, right? But AI needs immense physical power to actually run. And that brings us to a jaw-dropping figure, a $4.6 billion syndicated loan facility. A syndicated loan is basically a massive loan split among a group of lenders to handle the massive scale. And Citi's Tokyo branch is acting as a key agent here.
Let's look at the mechanics of how this works. This is a public-private partnership rooted in a September 2025 initiative to build out major energy projects in the U.S. The financing is flowing to U.S. investment companies set up by the Japan Bank for International Cooperation. And that $4.6 billion, it's funding major natural gas-fired power generation projects located right in the heart of the action, in Pennsylvania and Texas.
This is where it gets incredibly fascinating. The core driver here is the sheer, unyielding electricity demand from AI, data centers, and advanced industries. They are incredibly power-hungry. To sustain this massive digital growth, you can't just write better code, you literally have to build the physical energy grids to keep the hardware running. Traditional banking is stepping in to fund the physical infrastructure required to keep the AI revolution powered on.
And why this matters on a global scale is that it proves Citi can leverage its 125-year relationship with Japan to execute the highly complex cross-border financing that allied nations desperately need right now. We are talking about critical energy infrastructure and global economic security. By combining their global network with their public sector banking teams, Citi is positioning itself at the very center of the global technological arms race, providing the essential capital lifeblood it requires.
Which brings us to part 4, rewarding the shareholders. Let's look at the ultimate payoff.
First off, Citi's financial fortress is looking incredibly strong. They absolutely crushed the Fed's 2026 stress tests. A stress test is basically the government asking, hey, if the economy falls off a cliff tomorrow, can your bank survive? Citi's Common Equity Tier 1 capital, which is the absolute core measure of a bank's financial strength, hit 12.7%. That is a full 110 basis points above the regulatory minimum of 11.6%. They prove they are highly resilient.
And, as CEO Jane Fraser has noted, this momentum is translating into serious earnings. Just look at these Q2 2026 numbers. Earnings per share came in at $3.15, completely crushing the consensus estimate of $2.72. They posted decade-high revenue. And for the shareholders? The stock gained roughly 50% over the past year, vastly outperforming the industry. The strategy is clearly, undeniably working.
Because of that rock-solid financial strength, the first major payoff for investors is a quarterly dividend hike from 60 cents to 67 cents per share starting in Q3 2026. This is not just a token bump. A 12% jump is a massive signal of confidence from the board regarding the bank's sustained cash flow and future earnings capacity.
But wait, then there's this truly staggering figure, a $30 billion stock buyback program. By buying back that much stock, Citi aggressively shrinks the total number of shares out there on the market. That means every single remaining share in an investor's portfolio instantly becomes a bigger, more valuable piece of the pie. So why does this specific payout strategy matter? Because it shows that a bank can successfully navigate super strict regulatory scrutiny, pass with flying colors, and then confidently deploy its capital to heavily rewarded shareholders. Having secured a resilient capital base, Citi is ensuring that the tangible benefits of its massive strategic transformation flow directly back to the investors who believed in the turnaround.
Finally, Part 5. The future of banking and how this all ties into a unified strategy.
You see, none of these moves are happening in silos. They represent a highly coordinated approach to modern corporate banking. Through this explainer, we've seen Citi execute an absolutely brilliant trifecta, transforming retail rewards to a merchant-funded model with card, flexing their global muscle to fund international AI energy infrastructure, and backing it all up with an ironclad balance sheet that supports $30 billion in buybacks.
It really leaves us with a fascinating perspective to consider, doesn't it? We so often give all the credit to Silicon Valley for building the future we're stepping into. But when you look at the sheer unimaginable scale of capital required to make personalized commerce and AI-driven energy grids an actual reality, you have to ask, who is really laying the groundwork? As we've seen, it's the legacy banks operating behind the scenes funding the future. Thanks so much for joining me on this explainer, and I hope this gives you a much clearer picture of the incredible transformation happening right now in global banking.